Thank you all for joining us this morning. This is the regular Economics Hub, the Economics and Investment webinar with me, Ben Seeger-Scott, Chief Investment Officer, and joined as always by George Lagaris, our Chief Economist. And we're going to be covering everything that's happened in economics and markets and then talking about portfolios. As always, if you do have any questions, we had a couple of questions pre-submitted. There's a Q&A box at the bottom. So if you put your question in there, we will come to those at the end. So please do fill that out as it comes to you. If we go to the next page, I'll just talk through the agenda. We've changed the order slightly. This sort of tends to follow actually what tends to be our investment decision-making process. So we start with economics, what's happening in the world. George will cover that. And obviously there is a lot going on. Don't let this sort of recent lull that's already starting to ebb away lead you into a false sense of security. There's lots going on. So George will start with economics. Then I will talk about the market backdrop before finishing up on what we've been doing in investment portfolios. Then that's when we'll pick up the questions and answers. So without further ado, I'll hand straight over to George to tell us what has been happening in markets. George, over to you.
Hi everyone. So, everyone is expecting for inflation to show up. Tariffs are inflationary and inflation should show up. And in the US, it's not happening. In fact, it's not happening anywhere else. But the US is more important in this particular aspect because they suffer the tariffs, and firms should be putting prices up to be able to pay their dues to the government. And it's not happening. And it's got people, especially economists, asking why. So let's start with this. Okay, next slide, please. Now, as you see, the thick blue line says that US headline inflation is down. But actually now we're seeing price pressures from producers. So what's happening is that every month there is a survey called the Purchase Manager Index. And it is a sentiment survey of 400 businesses or thereabouts in every country. And they ask them, are you paying more for stuff? Do you hire more? Do you see more production? Do you have more new orders? And so on and so forth. So this survey suggests that for the last 2 months, there have been increased pressures in price pressures. And that is important because it's telling us that, okay, the headline inflation might be low, but actually simmering below that headline number, there are price pressures. Now, we'll explain why they're not so pronounced yet. The primary reason is inventories. So as you would imagine, Walmart and those companies, they built up inventories. They did it roughly before Mr. Trump came to power. So between December, January, even early in February, they were piling up inventories at lower prices to be able to weather a 3 to 6 month trade war. Obviously, you cannot build extra inventories beyond that. So now they're selling at the low inventory price and wait to see where the dust settles. Okay, so the primary reason is inventories. Okay, they're there and you can still sell at the previous lower prices, but obviously this will not last forever. Now, there are other reasons why price pressures are not so pronounced. Next slide, please. And the other one is that the US economy is slowing down. That same survey last month showed us that both manufacturing and services contracted in May. So anything above 50 means expansion, anything below 50 means contraction. And manufacturing, especially that's your blue line, was deeper into contraction territory. And by the way, that's where you would have seen the price pressures from goods, not so much services. First, goods go up, and eventually services follow. And that's true, by the way, not just about inflation, but about pretty much everything in the economy. Now, so number one, inventories. Number two, the economy slowing down, which in and by itself is not particularly inflationary. Number three, next slide, please. It's also twin tailwinds of lower prices and also uh, sorry, lower prices and lower Chinese producer prices. So what is happening is that China has a production glut, and now that's lost access to the American consumer, that is even more pronounced. Um, and also, oil prices are down nearly 20% since the previous year, since the same time the previous year. And that has to do a lot with Mr. Trump's agreement with Saudi Arabia. Now, to be sure, I'm not sure how long the Saudis keep this up. They would need around 80 to $100 per barrel just to maintain an even keel in their budget. So they can accommodate lower prices for some time, but not very long. And even if it wasn't their budget, the longer the lower oil prices, then more shell companies in the US go out of business. So supply is reduced, which means that all other things being equal, prices should bounce back up. But for the time being, this works. And whereas the shorter term thing is oil, the longer term thing, which is China's production glut, is a situation that actually becomes worse. So the US is lucky in that respect because, on the one hand, they sort of repudiated globalization, but now they benefit a lot from cheap Chinese goods. Um, and at least those that make it into the country, i.e., in a way, China has been eating some of the tariffs, if we want to put it that way. Chinese producers, that is. So this is pretty much what's going on. It is our view that inflation will pick up eventually, not just our view, the view also of many Fed members that now we're seeing the quiet period, but it will take a few months, and once the inventories are exhausted, then you could see prices going up higher. Already, a third of smaller businesses said they're pushing prices up in the next 3 months. Okay, in a recent survey. So there is that. Next slide, please. Um, let's just shift away from the US, which is facing slower growth and will potentially face higher inflation in the next few months. Interesting enough, and that's more important to the UK, we're seeing signs of life in Europe. German factory orders have pulled up significantly in the past 3 months. And also, we're seeing signs of life from the Italian economy, especially Italian retail, but also manufacturing numbers were good. Um, French retail is not doing so well, and there is an overall problem with the French economy. But we feel confident that the retail sector in Europe is still robust. So, to cut a long story short, Europe is not doing as bad. This is good for the UK because two-thirds of trade still happen with Europe. Okay, so you want a stronger Europe, especially now that America is shutting its doors. Um, now, um, the third element, and I'm so sorry, there is a slide missing. We had to take it out at the last moment, is what's happening in the UK economy. The data this morning showed the slowdown in April. We're not so much worried about that. The slowdown was mostly a services issue, and it might have to do with the differential between April and May in terms of the good weather and people going out to pubs and restaurants and going on holidays. So a lot of that could be seasonal. On the other hand, we saw the spending review, and we are confident that the UK economic growth could be better going forward. Having said that, for the time being, what we are seeing is an uptick in unemployment and a downtick in average salaries. So yes, on the one hand, growth could pick up in the next couple of years because of the spending review, but for now, economic conditions are weakening somewhat. So keep that in mind as well. Um, Now let's take a step back because I did give you the small picture, but it's time to talk about the bigger picture. And the bigger picture is what is happening in the debt markets and what are the wider themes we are seeing that affect our investment decisions and our general view of the world, as much as they affect businesses of all sizes. So next slide, please. The the three things that we're looking at, the three Ds of our investment themes, are debt, disruption, and deregulation. The world has suffering from a debt glut so pronounced that it could significantly disrupt debt markets at least. Uh, and debt is not it's not just a financial instrument. It's the loan you're taking out to build a small business. It's the loan you're taking out to take it to buy a house, or to refinance your house, or to even buy a TV. Okay, so we are seeing signs of stress in the debt market, and we're going to talk a little bit more about debt and the end game of debt, especially from a US perspective, because that's where it all starts. Now, in an era of so much debt, you would expect a modicum of disruption, and we are seeing the world drift apart. Everybody's trying to hide in their own corner, protect their own little thing. And we see a world that become more multipolar and more fragmented. And the final thing that we are seeing is deregulation. So if you're the White House and you see obviously that because of the tariffs and the trade war, there are going to be growth repercussions, what you really need to do is to start deregulating sectors fast, including the financial sector, which can create credit a lot easier like that. But also you can deregulate energy, drill baby drill. You can deregulate pharma to make sure that pharmaceutical products reach markets quicker. So this can provide a boost to growth. As you understand, it happens with the concomitant risks, but we're going to talk a little bit more about that in the next few minutes. So let's start with debt. We have a lot of debt. Next slide, please. Global debt to GDP, that's your right-hand slide, that's your right-hand chart, is at 325%. And interestingly, the number is 324 million. So they're pretty much the same number. And this is up from 220% in just 25 years. Okay, so we have a lot of debt. Now, the good news is sort of where the debt is. If you look at the left-hand chart, the debt is mostly with governments and non-financial corporates. This is important because if households had a lot of debt, then you'd have a major economic issue, and that would hit demand. If financial corporations, banks, had a lot of debt, this causes the usual systemic problems we've seen in '08. Now, governments holding a lot of debt is obviously an issue for the government debt market, which is a huge market, and as we said, it's loans for everything. It's your pensions. There's a lot of stuff depending on it, but the central banks can always print money to bail governments out. They're not going to do it for a simple business, but they will do it for banks and for their own governments. So keep that in mind because this is a major backstop in much of the economic grief that this debt accumulation may cause. Also, non-financial corporates, which means corporations that have borrowed a lot, but are still managing their payments, and also shadow banks, which are, however, less systemically important. Some of them can go under. Private equities can go under for sure. But private equities going under does not necessarily mean market trouble, not in the first instance, and not in the size and scope that we saw in 2008. So there is a lot of debt out there. It burdens governments. That means governments cannot spend much, and that makes people angry. And that's why we have the disruption that we have. And it is piling up to be sure. It is, I wouldn't say crisis level, but it is definitely stress level debt. However, again, at the end of the day, keep in mind that central banks are very important to this particular equation. Just to show you the magnitude of that. Next slide, please. So what we did here was we took $2,025 and we discounted it back to 1970 at a 5.5% per annum, which was roughly your inflation, just to compare sizes of debt. So in 1970, global GDP was $3 trillion, and it was supported by roughly $3 trillion of debt. Now, today's GDP is around $100 trillion, but discounted back to the 1970, that would be the equivalent of $6 trillion. And that is supported by, again, the discounted equivalent of 20 trillion dollars. So in the 1970, you were producing 3 trillion and you needed 3 trillion debt to support you. Now you're producing 6 trillion and you need 20 trillion to support that. Okay. Again, debt accumulation is significant. And we're going to talk a lot more about that in our future publications, in our upcoming quarterly. So keep an eye out on that space. But again, as we said, here we live in a monetary era where no country has to go bust. They can simply print money to pay off their debts. If you have a printing press, you do not go bust, at least not wantonly. However, it means that your currency will become cheaper. And guess what? The US government is happy with that. Next slide, please. Stephen Miran, the chair of the President's Economic Council, has said many times that he wants a lower dollar to help exports and to help to reduce imports and to help reduce the trade deficit. Many countries have used devaluation. Presently, since the 1700s, there only 20% of currencies that were around the 1700s exist to this day. So only 1 in 5. And all of them have devalued at some point. As you see, the US dollar, which is on the left, is the most severely overvalued currency globally. And that's because of a lot of inflows in the past few years, especially after the pandemic. So you know what? The US government is happy to monetize some of that. It's happy to reduce the value of the dollar. Um, and um, and keep that in mind because this could be a big theme going forward. Leona, can you please jump 2 slides and take us to slide 13? Thank you. Now, within the Economics Hub, we have deliberated 5 scenarios. How is the debt going to play out? We talked about the responsible case, i.e. restructuring of debt or simply not spending much. We gave it a 1, 3 in 3 probabilities for that to happen. That is relying on the best of human nature. Experience shows that unless a country has a gun in its head, usually they don't choose that sort of responsibility. You can monetize your debt, to which we gave a roughly 60% probability, i.e. print money to pay it off. You're going to inflate it away. And the question is, well, what if everybody else also starts to print money to make sure that the currencies are competitive? Will you get into currency wars, which we do see as a potential outcome here? And there is a 10% probability where you simply have this so high debt that you need to be making interest payments, very high interest payments, and that kills growth, and you end up with a Japanized global economy. And it doesn't matter how much money you print, you have fallen into a liquidity trap where easier monetary conditions are not necessarily conducive to growth. So we think that it's more likely than not that the debt will be monetized. Now, this is the debt issue. We'll talk about disruption for a couple of minutes. Next slide, please. So we used to have a synchronized economy, but now it's really desynchronizing fast. The US is moving faster into the inflation cycle. They're about to see their inflation. UK and EU are struggling to get growth um, because of their previous policies. And China's at the point where it can't get the growth that it's want. It's sort of been falling into this liquidity trap where it's been lowering interest rates for 4 years, and it sees its growth. It's not bad, but it's slowing down, and we do see evidence outside the official numbers which tell us that the Chinese economy is not doing so well. That's why they're eager to get back to the table with Mr. Trump and have an agreement. Um, Next slide, please. Another sign of disruption is not just divergence, but it is also trade wars. So what the US is telling us is, I have a lot of debt. I'm not growing as fast as I want. I want some of your growth. So we'll impose tariffs and then start negotiating trade deals that are going to give me an advantage. Okay, now presently, average tariffs are at about 16%, which is about 6 times higher than the previous average of 2.5%. Already we're reaching the point where in a modern global supply chain, that's not necessarily sustainable. Right now, tariffs are at 1940s level just before World War II. So keep that in mind because this is a world now that's becoming increasingly strained. It is the debt that lowers growth and that creates disruption and divergence and leads up to a point to the devaluation of the dollar. Next slide, please. So overall, slower growth across the board, higher US inflation, except if we see a deep US recession. We expect lower inflation in Europe, and the jury is still out as to what will happen to the UK. Overall, higher unemployment, and at least the silver lining for growth is higher capital expenditure for businesses because they now need to adapt in a world where supply chains become more extended and more complex. As for deregulation, and we do have experts in the firm like Mr. Rick Loutier who can always talk to you more about that. Mr. Trump wants to deregulate banks and the insurance business, energy, pharma. He wants to reduce. He wants to not reduce. I'm not to yes, to reduce accounting regulations and reduce supervising bodies. Our view is that over the short term, this does help growth. Over the long term, it creates significant risks because crises usually start a few years after somebody has tweaked the regulation here and there. And now we're talking about the massive tweaking of many regulations. And with this, I think I need to yield the floor back to Mr. Dr. Ben Seeger-Scott.
Thank you, George. Is that your deregulation slide? Markets, there we go. Brilliant. Well, thank you, George. Hopefully that's given you a good sense of where the economy is, but also some things that we're looking at, some of the complexity that we see in the outlook. So as I said at the start, it's important to avoid complacency, and the outlook is complicated. And of course, there are risks, as George talked about, but there are also opportunities. Just turning to the markets now, and on the next slide, you can see the performance of markets year to date, and there's a couple of different things in here. I've shown developed market equities, government bonds, and emerging market equities. And in short, the markets have largely recovered from the initial shock of tariffs post the Liberation Day announcements. You can see the market has bounced from down about 13% to be only down a couple of percent in terms of developed markets. So a lot of the shock has worn off, but still not at those previous highs, given the slightly tougher outlook. Emerging markets have continued to do pretty well. Those will have been helped by the weak US dollar that George talked about a little bit as well. And weak US dollar tends to be good for emerging markets and emerging market currencies, of which emerging market equities are obviously denominated in. And I think you can see from the government bonds there, they've drifted sideways, and that's not a bad thing. We spent quite a lot of time debating where yields are going to go, where borrowing costs are going to go. Your sort of benchmark 10-year government borrowing costs are around 4.5% at the moment, and they fluctuate up and down. But it's important to remember that's a yield you get throughout the year. So even if government bonds don't go anywhere and effectively stay flat with a bit of volatility, they'll still accumulate 4.5% through the year. So you can see, even without them having done very much, because there are some inflation concerns floating around, government bonds have still delivered a positive total return thanks to that income. And diving in a little further, developed market equities overall are still fractionally down, but there is still this difference in terms of regional performances. So as usual, the next slide just shows the different developed market geographical geographical performances. Can we go back and forward and see if we can just refresh those indices? Okay. No. Okay. We can. I will just talk you through them because fortunately I know what they are. These are the same data again, and all that you need to know is that that dark blue line at the top is Europe, and Europe is actually still up comfortably double digits. Europe, I think, is up about 15% so far this year. The UK, which is the light blue line that has bounced back, that's still up 10%. So actually, developed market equities, it's the US, it's that green line at the bottom that is dragging the previous number down. So that green line at the bottom is US equities that have recovered, but are still 5% down. Do not think that all markets are down. The US is down, and that's the major component of developed market equities. Japan is flat, which is that sort of light line that's around zero. And then the UK and Europe are still performing pretty well. Double-digit gains is well ahead of what you'd expect from average markets on a 12-month basis. So if we go to the next slide, please, that's where markets are performing. I just wanted to touch in this section on fundamentals and earnings growth. George has laid out before that sort of tougher economic environment that we're seeing. And again, that creates some opportunities and some risks, as well as economic growth, which is the broad backdrop. For equities, we want to look at how are company earnings doing. So this just shows earnings per share. So this is earnings growth over the next 12 months. And these have been revised down because of the ongoing trade war, but in some parts they're still particularly strong. Emerging markets, of course, has a much more positive outlook, again, helped by the weaker US dollar. US earnings growth for the next 12 months is still very strong. 8% earnings growth is very attractive. Now, that's come down at the start of the year. We were looking more at sort of 12 or 14%. And you'll recall at the start of the year, we were saying that looked pretty optimistic. They've now come down to a more realistic level, but the US is still a very productive and relatively insulated economy. So 8% earnings growth for the US is pretty attractive. Conversely, the UK there, you can see earnings growth is expected to actually contract over the next 12 months. And this comes on top of the tough news George talked about earlier. Obviously, this morning we had weaker GDP numbers. Unemployment is rising, inflation is going to be a challenge, and earnings growth expectations are negative for this year. And when we talked before, that strong equity return that we've seen from UK equities so far this year, a lot of that's come from valuations coming in, and that's not necessarily sustainable. So that's how the fundamental picture looks. Again, hopefully you can infer from this there are risks and opportunities, and that's how we continue to manage the portfolios. Going on to the next slide, please. We can transition from the markets to what's happening in portfolios and how we're managing your money. The next slide will just show where our current positioning is. In last month's webinar, we talked in more detail about the changes that we made in April. And as a reminder, it was the 18th of April that we carried out the rebalance, which was really in the middle of the sharper parts of the fall in equities markets. So as a starting point, by rebalancing where we take profits on areas that have done well and top up areas that have fallen, that will naturally have taken advantage of that dip in the markets. In terms of the asset allocation change, we increased our US equity, so we were underweight coming into the latest rebalance for reasons we talked about last year. We took the opportunity to add to the US to bring it back to a neutral weighting, and at the same time we took some profit from energy equity, but crucially at the top there, you can see UK equity. And that's because UK equities have had a very good run so far this year. But as we highlighted, there are growing pressures for the UK economy. That is likely to be translated into trouble for the UK stock market. So we're taking profit on an area with a more troubled outlook and topping up an area we still think can continue to deliver. The only other thing I'd highlight on this slide, if you cast your eyes down to fixed income, whereas we are again, there are a few rising inflation concerns. Certainly, we're not thinking the 2022-2023 environment where inflation got materially out of hand and extremely high. But as we may see slightly higher inflation ticking through, you can see in that government bond line, as well as having traditional conventional government bonds, we've also included some inflation-linked securities to try and mitigate against the risk of rising inflation. So that's our portfolio positioning. A few slides just talking about performance of our portfolios. So on the next slide, with all of this doom and gloom partially dissipating, this shows the performance of our portfolios so far this year. These are our core portfolios. The blue lines show portfolio performance. The grey lines, as usual, shows how the peer group, this is measured by asset risk consultants, how they are doing. And I think the good news is across the piece, defensive is flat. In the last few weeks, we'd expect that to have ticked up slightly. But the good news is year to date, all of our portfolios are back in positive territory and comfortably ahead of the peer group. I think the changes we made at the last rebalance will have aided that as well, again, through that top-up mechanism and also some of that reallocation to a market that has performed well. So that's just for context of how portfolios have fared through this disruption. More meaningfully, though, on the next slide, if we look at 1 year, which is the sort of shortest period that we would consider thinking about if we were thinking short term, because we try not to make month-to-month trades. You can see across the piece, our performance on a 1 year basis, I think, is very good. Obviously, at the higher risk end, where we have more in equity, our performance is comfortably ahead of peer group and where we would expect to be. And at the lower end, I'm still very happy with the caution defensive portfolios. Their role there is much more around preserving capital, and I think those return rates on a 12-month basis are where we would expect them to be, trying to take a more defensive stance rather than sweating for higher returns. So very happy with performance on 1 year. And on the next slide, I think a longer term measure, again, still relatively short term on 5 years, but just to remind people, even with the disruption, the long term, this sort of 5 year performance of portfolios is still, I think, very respectable and comfortably ahead of peers. Finally, I will touch on the sustainable portfolios in the next slide. Of course, so these are the same data over 5 years. As we know, the sustainability constraints have been a little bit of a headwind over the 5 years to the end of last month. If you consider in the broader scheme, sustainability had a very strong period around sort of 2015 to 2020, particularly when more cyclical areas and fossil fuels and other areas were struggling. We have seen over the last 5 years, sustainability constraints have caused a few headwinds, but I'm actually quite pleased that we've managed to broadly keep pace with the peer group. But again, remember these ARC measures are for unconstrained, so all portfolios go into these measures. These are the same as you saw before. Even with a sustainability constraint that's had headwinds in the last couple of years, we're pleased that our sustainable portfolios have largely been able to keep pace with the peer group. So if we go to the next slide, please, we'll wrap up there. Our next slide I'll conclude, and then we'll go towards the Q&A. So again, our economic outlook is based around those 3 Ds: debt, disruption, and deregulation. And George has touched on each of those elements there. We talked through how economic headwinds are starting to accumulate amidst the trade tension. We've seen some concerns over inflation and economic activity. Weak in the UK, that's transferring through to earnings. Tougher in the US, but earnings growth is still robust and signs of positivity in Europe. So it's a mixed bag, and that creates opportunities as well as risks. Equity markets on the back of that have largely bounced back, with Europe and the UK doing particularly well. And from portfolio performance, all core portfolios are back in positive territory for the year to date, and multi-year portfolio performance is still very good, I would say. The next two slides will just sort of flash up. As always, these are the topical cheat sheets. There are lots of things going on in the background that we can't cover in one call, but we do have sort of one-liners, what we think of geopolitics and AI, and obviously tariffs and the trade tensions that we've only touched on. So there's just some one-liners there. And on the next slide as well, we just have a few more. So the UK economic and fiscal situation, oil, gold, crypto. We think about all these things even if we haven't talked about them today. So on the next slide, this is the holding side that we will just pause on as we go to the Q&A. I've got one that was submitted in advance, and then I will come to the ones under live fire. The first one was about US dollar depreciation. George, this is going to be one for you. So the question is, essentially everything that the US government seems to be doing, even if they're not saying it out loud, is likely to lead to a weaker dollar. How do you invest in a weaker US dollar environment?
Well, first of all, you accept that this is a very possible outcome. It's an outcome that a lot of governments have pursued over the years, not just the US. It is weird because the US is the steward of our global economic and financial system, so it does seem weird to wanting your currency to depreciate, but it's the third major depreciation. Sorry, the US has been through three major over 30% depreciation since the 1970s, so it's not a new thing. How do you invest? You make sure that your dollar exposure is hedged, more or less, and you make sure your asset allocation is diversified enough because a lot of investors might be running away from dollar investments. This would be the key principles.
Yeah, I would agree with that. The only thing that I would add from a portfolio investment point of view, it doesn't necessarily mean divesting from US equities, because as we see globally, when your currency falls, a lot of companies can see their equity rally as their revenues translate at a more attractive area. I would also highlight, I touched on it earlier, emerging market equities tend to benefit as well. As you may recall, in our riskier part of our fixed income, we exited our high yield or junk rated corporate credit and put that into emerging market local currency bonds, a sort of like for like switch in terms of risky nature in fixed income. But again, part of that driven by the view that emerging market currencies tend to fare well in a weaker dollar environment. So we remain diversified, but there are a few areas that we are sort of tilting towards that. Turning to the questions that have been sent in, there is one on gold. Obviously, we sold that at the start of the year, and it has continued on a good run. So the question is, what's your stance now in this regard? I think I would say two things. We had some gold that rallied incredibly well through 2024. I think it's very hard to call the top in any market, but obviously it has sort of rallied through this year. I think our stance is unchanged, and that is that central banks have largely balked at the higher gold prices. We do think structurally in long term they want to diversify their holdings, but when gold is above $3,000 a troy ounce, it becomes relatively less attractive. And a lot of this is being bought by investors as a fear hedge. And I think as we start to see some of the biggest fears subside and move more towards a grind through, for those more price sensitive investors, gold will appear less attractive. Like I said, we've switched that gold into government bonds, particularly inflation linked, that's yielding you 4.5%. Gold yields you nothing. So yes, in the short term, and actually what's happened this year, gold rallied about 15 odd percent to March, and it's moved sideways in sterling terms. What we have seen, because gold is not a native dollar asset, but it's priced in US dollars, if you just look at the US dollar number, gold has gone up throughout this year, but actually it rose on a broad currency adjusted basis to March. and it's just flatlined. So if you are a euro investor, sterling investor, or a yen investor, gold has basically gone nowhere. And I think, you know, that price movement has obviously helped in the first 3 months for those people that held it, but it's not going to yield you anything. Whereas government bonds provide a steady yield. And I think as investors look more to the long-term return they're getting off these assets, you are more likely to see some appetite for non-gold assets, and we do expect it to fall back. We are not fully against gold. We just think it has been excessively bought, and a lot of that hot money that's flowed in this year on those fears is ripe for exiting. So we would be looking to re-enter, and you know we've said this before. The terms of the trade was exiting when it gets to these high levels and re-entering when it's closer to 2000, and nothing has really changed in that regard. One for you, George. George, can you expand on the Eurozone situation, in particular Germany? Assume it's driven by defence investment announcements and France's struggles. So what's happening in the Eurozone?
So the German economy has improved prospects because their debt situation has been stable and very good for many years. So now they can expand their economy through incurring more debt without really jeopardizing their overall fiscal position. And we know being Germans are going to be very sensible about it. Um, Having said that, and they will be very sensible about it, but it doesn't matter how sensible you are. When you start accumulating debt, at some point you start accumulating at a more accelerated pace just to meet your previous debt obligations. I think this is a trope that repeats itself historically. It doesn't matter how responsible a government is. That's why we said our base case scenario is not fiscal responsibility and going back to lower debt. Um, and because I'm Greek, by the way, lowering your debt dramatically has a lot of um, social implications that are not very welcome by any political class. So the German economy is bound to do better. The French economy already has a lot of debt. Consumption is not doing very well. They have political problems, and that has they have dented um, uh, consumption and consumer optimism. So the one economy seems to be doing better. Personal opinion, humble opinion, is that Mr. Merz seems like a very sensible politician who can become a key leader in the Eurozone. Um, uh, Whereas Mr. Macron is facing significant internal opposition. Um, we also see Italy improving both in terms of consumption and manufacturing. Spain, on the other hand, is not doing so great. Look, the Eurozone economy will slow down, obviously, like the rest of the world, and tariffs are going to hurt it. It doesn't appear that uh, there are big inflationary pressures. The ECB has lowered rates as much as it can for now. Rates should be about 1 percentage point higher than where they are now, which means that the situation is very accommodative. But we do still expect a growth slowdown, not major inflation. Um, and Germany may sort of be, from the big countries, Germany may sort of be in the less losing end, and France in the more losing end.
Thank you very much, George. I'll pick up the next one and see if George has anything to add. The question is if we anticipate a recession in the US, and if we were to assume a recession, is it reasonable to assume global recession as a result? My view is, or our view, a recession is not likely in the US. It is a significant tail risk. We probably at the moment our estimates bounce around a little. I would say the probability of recession is probably in the 20 to 30% range, so probably about 25%, which isn't immaterial. But I think if you look at the bill passing through Congress, which is for tax cuts, it's for stimulus efforts, and there is an appetite to increase debt. And I think if you look at the Federal Reserve, they are poised to provide stimulus if deterioration does start to happen. So I think there are plenty of tools around to intervene to avoid a recession. I think that is not to say there are no risks. As George talked about, the risk is debt builds and it causes more broader systemic problems down the road. But that is a problem for later. I think that every expectation is that various global deals will get made. The fiscal stimulus measures, which tax cuts are, will come through, and the Fed is ready to act if needed. And they have said as much in the past. It is difficult to see, as long as you don't have recalcitrant policy that refuses to shift and effectively says bring a recession on, that the US lapses into one. And I think everything we've heard from the White House, just a few comments of they aren't afraid of a recession, but I think what their behaviours have demonstrated is there is tough talk in which is needed for negotiations, but I don't think there is strong appetite to tip things over. It's not to say it's impossible, but not very likely. But if it were to happen, if the US goes into recession, it is likely to drag the rest of the world into recession as well. What happens in the US does tend to undulate out. It is the largest global economy in the world. We're already seeing China has a few domestic challenges as well. So if your two largest economies get into economic difficulty, it is very likely to drag everyone else down. That again is partly the reason that we increased the US, because ironically, if things do go wrong in the US and the US falls into recession, it is quite likely to drag the rest of the world down. And in that environment, unfortunately, the US market and economy tends to do better than other much more cyclical and interconnected economies. So even if the US does go into recession, within intra equity, you probably want more US equity than other regions. George, anything to add before I throw the next question at you?
Just that this morning a report emerged from the FT that the US is happy to grant access to technology to Chinese companies as part of being able to re-import rare earths. Uh, and that just shows how badly they do want to deal. I think, and Ben, I think you said it better than I ever can, but there is a very marked difference between the amount of noise and tough talk against the actual result. Those two don't much match. You're going to hear a lot of tough talk and a lot of tweets and all that, but at the end of the day, the deal is likely to change. It is unlikely to even move the needle much.
Good. Thank you, George. The last two questions we've currently got in are both around debt in debt and interest rates in one guise or another. So firstly, I'll bounce them both to you in the first instance, George. George, just reflect something we were talking about when we were looking at government debt, financial debt, and non-financials debt. So Paul asked, why is it okay to default on shadow debt without a government bailout in contrast to banking debt? And why does it make a difference who owns the debt?
Okay, so um, let's say that Ben is a bank and he has a problem. I need to bail him out as the Fed because basically he's just sitting on your deposits. So if he has a problem and he's not able to pay his depositors back, then that creates a bank run on other banks as well. That one also. Uh, and basically, he'll be holding society hostage. So you need to bail out banks, and that's what central banks have been doing for decades. Now, let's say Ben is not a bank, however, but he is. Sorry for picking on you, Ben. Let's say he's a private equity, which means he is very rich, and he's made some very bad leveraged plays to buy biotech companies, and they all go south because the economic situation goes south. Now, on first instance, he has a lot more fat to burn, for lack of a better turn of phrase. As we said, Ben in this particular example is rich, so his private wealth will be eroded, and then whatever money he owes to the banks, obviously the government might have to step in. But because those private equities are backed by wealthy investors, they have to suffer the first wave, which is completely different thing than defaulting, having a bank default, because that just affects all depositors at the same time.
Thanks, George. Yeah, I would sort of echo that. To be clear, it's not that the governments like banks and want to bail them out. what is important to remember is that one function of banks is a transmission of monetary policy. You need banks so that when the central bank increases interest rates, people's mortgages and credit cards go up. They cool the economy. When they cut rates, they go down, and it stimulates. So, and that is why, whilst governments have bailed out banks in the past, post global financial crisis, they've been very keen. That's why there's lots of work to try and separate out retail. So, retail banking from investment and risk taking banking. They've done a lot of work to increase or to reduce the amount of risk that banks are allowed to take. That's why you have all this focus on tier one capital ratios to try and discourage that level of risk taking. And they're trying to create these bail-in scenarios where banks have this sort of, how would you manage if this were to happen? So they've had a lot of regulation to try and not do that again. But as George says, what governments try and do is try and see where there is debt been issued by risk-taking institutions and private investors, that they wear it as long as there is no pushback onto the public good of monetary transmission. And what I would highlight, the governments have done this before, and that's what materialized the global financial crisis. It was Bear Stearns that said we're about to go bust, and the government said, well, they looked at the balance sheet and said, actually, these are all private investors. You're not helpful for that transmission to the end consumer. We're going to let you go bust. And that's when it turned out that there were all of these complexities that authorities have spent the last decade and a half trying to unwind. But hopefully that shows some of the difference there. And then the final question, again, I'll bounce to you first, George, in a related area, more central bank, this one. And this is from Christos. Is any QE, so quantitative easing tactic, likely from the Fed, more likely from the Fed after Jay Powell steps down? And is there a likely ceiling that would trigger that? So, for example, the 10-year getting 5% or higher, is that likely to trigger a sort of QE response after Jay Powell? So, George, over to you.
Yeah. So what does the Fed do after Jay Powell? That is an interesting question. To be sure, we'll likely have a Fed president who want to put interest rates down and maybe more keen to print money, do more QE, jump on the market when they see difficulty, when the U.S. government has difficulties borrowing. So all of these things are likely to happen. However, as Ben and I have discussed many times, Powell is a figurehead. The Fed will not change policy just because it changes president. The president has a double vote, and I think, Ben, correct me if I'm wrong, the double vote is only in effect if there is if there is a tie. That's when it's only a double vote. Except for that, it is a single vote. Historically speaking, before the 1950s, dissenting votes had usually come from presidents, and Jay Powell has made sure that this is a more democratically run Fed, which means that all of the governors will have a say in what happens. So just to be clear, I don't define Jay Powell's change as necessarily a Fed change. You know, it could nudge things towards a certain direction, but that does not mean a total change and a sort of Arthur Burns type of central banker who will just carry out the president's wishes, like Arthur Burns did with Nixon in the 70s. So just to be clear about that. Now, having said that, if the U.S. government has problems borrowing, the Fed will step in. It's part of its mandate, and they will print money, and that money will become eventually a fiscal outlay for the U.S. government, which means it becomes helicopter money. Okay, but to do this, you need signs of stress in the primary auctions from the Treasury. We have seen some irregularities, I would argue, but not necessarily anything that cries stress. Would you agree with the choice of words here?
Yeah, I think that's probably fair. I think Christos is right that the 5% level is a psychologically important one. I don't think that necessarily means that the Fed would intervene in the first instance. What we have seen, actually, in the 30-year, even further out, when that got to 5%, this is really, this I think was interesting. That's when Donald Trump first started pulling back on tariffs. It was not when the equity markets crashed. It's when the 30 years started to get to 5%. It starts by triggering a government response. And I think, when Jay Powell steps down next May, we're already seeing likely names. Scott Bessent, the current Treasury Secretary, has been floated as a possible replacement. But I think the two things to add in there is, firstly, it is a misunderstanding that the Fed just hikes rates and cut rates and that changes long-term borrowing. Borrowing is largely set by the market and what markets think long-term interest rates will be. And crucially, that relies on the credibility of the Fed. If people don't think the Fed is credible in its long-term management of the economy and interest rates, then you'll have this breakdown. And that's when long-term rates start to go crazy. So it's not just what the Fed chair says, it's whether or not there's credibility. And that's something Scott Bessent, Treasury Secretary, really understands. And that's why they're so keen. That's why all of the talk about ending Jerome Powell's term early disappeared, because the Treasury understands that level of uncertainty itself is a risk. So it may be that the replacement could be a little bit more progressive, but I think they will try and shy away from QE. Not least Ben Bernanke, one of the previous but one Fed that started doing QE post global financial crisis. He is quite famous saying the problem with QE, it works in practice but not in theory. And central bankers are quite scared of QE because there are lots of unknown and unintended side effects. So I think they are less likely to try and push it in the short term. They're more likely to try and, if anything, ironically, keeping interest rates high helps to lower long-term rates because it lowers inflationary fears and brings those down. So I think there are lots of feedback loops. The final thing I'll say on that, since it's our last question, we can then wrap up. One of the related things that we're looking at the moment, we've talked about it before and it's back in the news, is this risk of a shadow chair. And because, as George says, the Fed is effectively a figurehead and a spokesperson for the Federal Reserve. But if you know they're going next year and they already announce who the next chair is going to be, the risk is you have a Fed chair who is coming in, and we saw this with the current president before he was put in post. People will start having two people to listen to, the current Fed chair and the incoming Fed chair. And the risk, if that rhetoric is at odds, that could cause some market turmoil. And with that, we are out of time, so I will just leave it there. Thank all of you for listening and for your questions. Thank George for his contributions, and thank Leona, who has helped us run the webinar as is. Thank you very much. If you do have any questions in the meantime, you know where to find us, and reach out to your regular Forvis Mazars representative, and we'll speak to you again on the next webinar. Thanks very much, everyone.